The Dutch East India Company used hundreds of ships in the 1600s to conduct international trade in silks, gold, porcelain, spices, and other goods. But it wasn't inexpensive to manage such a large company. The corporation turned to private citizens, people who could invest money to support the journey in exchange for a percentage of the ship's profits to finance their pricey travels. By engaging in this strategy, the business was able to fund more greater expeditions, boosting earnings for both itself and their astute investors. The Dutch East India Company unwittingly created the first stock market by selling these shares in coffee shops and shipping ports all over the continent. Since then, firms have been raising money from eager investors to support a variety of industries. And today, there are entire television channels, colleges, and vocations in the stock market committed to comprehending it. But the contemporary stock market is considerably more intricate than its initial form. So how do businesses and investors currently use the market? Consider a brand new coffee business that decides to enter the market. The business will first market itself to major investors. If they believe the business to be a good one, they get first dibs on investments and sponsor the IPO of the business. This places the business on the formal public market, where any corporation or person who thinks the venture could be profitable may purchase a stake. By purchasing the stock, investors become a small stakeholder in the company. Their contribution aids in the business's expansion, and as it prospers, additional investors may start to recognize its potential and purchase stock. As the demand for such stocks rises, so does their price, raising the barrier to entry for potential buyers and boosting the value of stockholders' existing holdings in the company. By demonstrating how many individuals are prepared to invest in their idea, the company's increasing interest not only subsidizes new initiatives, but also increases the value of the company's stock as a whole. The opposite can also occur if, for any reason, a business starts to appear less profitable. Investors who believe their stock value is going down will sell their shares in an effort to gain before the company loses any more value. The market value of the company decreases along with the stock price when shares are sold and demand for the stock declines. This might result in significant losses for investors, except if the company starts to appear profitable once more. Hey, has this video given you some food for thought? We'd love to hear some of your insights. Comment down what you loved so far. Let's return to the video. Numerous factors affect the supply and demand pendulum. Market dynamics, such as shifting labor costs, changing production technologies, and varying material prices, have an inescapable impact on businesses. Investors may be concerned about shifts in management, negative press, or more significant things like new legislation and trade policies. And naturally, many investors are only prepared to liquidate their precious stocks and pursue their personal interests. Due to the daily market noise caused by all of these factors, businesses may appear to be more or less successful. Additionally, in the stock market, losing investors as a result of a perceived value loss might result in actual value loss. Market confidence has the ability to start anything, from financial crisis to economic booms. The majority of experts recommend dependable long-term investing versus attempting to earn quick money because of this hard-to-track element. In spite of this, professionals are continuously developing tools to improve their chances of achieving success in this wildly unpredictable environment. But only the wealthy and powerful have access to the stock market. As the internet has grown, Many of the same methods used by major investors to purchase stocks are also available to regular investors. And as more people gain knowledge about this intricate system, they can trade stocks as well. They pursue their financial objectives while supporting the companies they respect. Remember, guys, investing is the initial step. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching.